All right, so let's take a look at some other measures of yield. It's not just yield to maturity. So on this slide, so here's the data we're given, and this is the exact same bond that we've been looking at in the one previous video. Right, we've got a par value of 1,000. It's a 10-year bond, 8% coupon. The quote price is 114.877% of 1,000, right? And this time, it's also going to be callable in 5 years at 110. And what that means is that in 5 years, the issuer, the company, can decide to call back the bonds to pay off their debt early, basically, but they're going to buy the debt, but they have to do it at a price of 110 or 110% of par value, which is $1,100. Okay, so first off, bond equivalent yield. That is basically the same thing as yield to margin. I'm sorry, sorry, as yield to maturity. Right, yield to maturity is what we usually call it, but there are some other names sometimes, and bond equivalent yield is the one here. And if you recall from that previous problem, we calculated, right, the periodic yield of 3%. It's a 3% yield every 6 months, right? And so what you have to do is you have to take that 3% and multiply it by 2 periods per year, and that gives you the regular yield to maturity or bond equivalent yield that we discuss and use of 6% in this case, right? This one, the effective annual yield, and you know what? I have to write something in here. It should be 1 plus periodic yield. This basically recalculates yield as if you could reinvest your coupons and get the same rate of return all the time. So it takes compounding into account because the way this is calculated, if you recall back to Finance 300, it's simple interest, right? It just gives you the interest you get every period without assuming that you're going to get extra returns from reinvesting your interest or dividends, right? So this takes into account compounded interest, reinvesting your dividends. All right, so the way to calculate that here is it's going to be 1 plus your periodic yield again, right? But then we're going to take it to the power of 2 periods per year, and then subtract 1. And if you do that, let me see, you should get around 6.09%. Whoops. Okay, so it's a little higher than the bond equivalent yield to maturity because you're it's like getting interest on interest, so you're reinvesting your coupons. This one, current yield, it's a little confusing because it sounds like, oh, what's the current yield to maturity? No, current yield has a specific thing, and what it does is it uses the coupon payment and divides it by the current market price, right? So the annual coupon in this case, it's 8%, so it's 8% of 1,000, right? And you divide that by the current market price, which in this case is 148.77. Right, so it looks at the bond coupon payments almost like if you just put the money into a savings account and you're just like living off the interest, that was it. It ignores the repayment of the principal at the end. All right, so it's just looking at kind of like short-term income, and if we do the math on that, it ends up being 6.96%. Okay. And the last one is yield to call. So what this means is we have to recalculate the yield to maturity, But in its place, we're not going to go to maturity in 10 years. We're going to go to the call in 5 years. So we're going to change out some of the information here. We're going to change out the future value because it's going to be $110 or $1,100, and it's going to be in 5 years or 10 periods. So we're going to redo the calculation here, and let's go ahead and do that here. Let's see here. So we'll do equals rate. We want to know the yield to maturity. We calculate that with the rate. And the first thing was we have to know the number of periods. And it's going to be 5 times 2, right? And the payment is going to be the same as we had before. I think it's 8% annual coupon. So I think we said before is $40 per 6 months per period, right? And the present value, put the negative sign there. In a minute, I'll show you what happens when we don't do that and we leave it positive. Okay, so that's the present value. And now we put in the future value, and this is where it's 110% of par value, or 1,100. And so that should give us the yield every 6 months, right? Did I miss anything? I think that's good. Now remember I said to check the default on here on the number of digits. And you want to hit this one. See that? So it's 3.11%. But we have to multiply that by 2, right? Because it's, so it would be 6.22%. There you go, 6.227, something like that, right? 6.227, yeah. And let me just double check here if it's the same as the solutions down below. Yeah, it looks the same as down below. Okay. All right, let's take a look at the next slide here. So if you buy a bond and then sell the bond, let's say 6 months later, one of the things you remember from Finance 300 is that bond prices change over time. So if you want to look at your total return, which is coming from not just the coupon, but also the change in the price of the bond between when you bought it and sold it, we have to use this equation to calculate that. It's called the holding period returns. So let's take a look at an example here. And this is just like any return equation, right? The change in price plus the income. In stocks, it's dividends. And here it's coupon divided by the initial price, right? So why don't we do that here? Let's say So P1 in this case is the ending price, so it's 1068, right? 0.55, and we subtract the initial price, which was given as 1,000, and then we add to that the coupon, and in this case it's a coupon of 8%, right? So it's going to be 8% of 1,000 is 80. But it's split over 2 payments in a year, so it's going to be $40 per year, right? And then we just divide that by the initial price of 1,000, and that should give us our holding period return. And let me just double check here. Looks like 10.85%. Okay. All right, let's take a look at something called TIPS. And that's just an abbreviation for Treasury Inflation Protected Security. And so I think the key thing to understand here is how does a TIPS protect you from inflation? And if I didn't know any better, and if someone just asked me, intuitively I would say, oh, the interest rate, it gets adjusted for inflation, right? They're just going to up the interest rate by the CPI, like Consumer Price Index or something. No. That wouldn't work. And the reason it wouldn't work is because, the coupon payments, okay, they get adjusted because you're changing the interest rate. But what about that payment at the very end, right? The repayment of the principal. That doesn't get affected by you changing the coupon rate. But the value of that principal is going to be affected by inflation. So somehow you got to do something that not only compensates for inflation's effect on the coupon payments, but also the repayment of par value. So the answer is, the way inflation protects investors and tips is it adjusts par value. So this slide here kind of shows an example of that. So look at here. We got a par value of $1,000, right? And let's say in time period 1, inflation is 2%. Okay, so the par value gets upped by 2%. So it goes from 1,000 to 1,020. And now we calculate the coupon payment, and you see 8% or 4%, sorry, of the 1020, and now it's adjusted because it's 4080. If inflation was 0 after that first time period, the coupon payment would have been 40, but it's adjusted. And we see the next period, par value goes up again. The coupon payment is recalculated based on the adjusted par value. Same coupon rate, that never changes. And the key here at the very end, when the principal gets repaid, it's based on this inflation adjusted number. So we got the coupon payments have been adjusted because of the par value adjustment, and the repayment of the principal has been adjusted based on that par value adjustment. Coupon rate stays constant. It's only the par value that gets adjusted. Do you remember this from Finance 300, that relationship of how bond prices and yields kind of are inversely related, right? So if, for example, if we have a bond that's at $1,000 and an 8% yield, which is what we've just been covering, right? What would happen if interest rates went up to 10%? Well, the bond price goes down to 8.10. So this bond price and yield, it turns out if we were to calculate all the different variations of interest rate and what would happen to the bond price, it turns out it follows this curve. Okay? It follows a curve. So just imagine, remember we were looking at that callable bond at 110? Look at this example, right? So let's imagine a company has a bond and interest rates start to fall. It's existing, or let's assume they had a straight bond with no call feature. The price of that bond, as interest rates fall, the price of that bond goes up, 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 up. It follows this red line right here. But if they have a call feature, when interest rates go down, that company has an incentive to refinance at a lower interest rate. When interest rates fall, people want to get new loans at lower interest rates. Okay? And in this callable bond that we looked at, remember it was callable at 110. So what happens to this curve? On a callable bond, if you follow the black line, it's going to flatline, right? And it's going to flatline at the call price, because no one's going to buy that bond for more than the call price, knowing at any day the issuer could call the bond back, and that we already know that they're not going to pay more than $1,100. So that means investors are going to pay no more than $1,100. This basically shows kind of the glide path when you have a premium bond on top. That's the solid red line. And a discount bond on the bottom. That's the dashed red line. So remember, a premium bond is a bond whose price is greater than $1,000. And if nothing else ever changes in the market in terms of interest rates, the bond price, by its very nature, when you calculate present value, the present value of the cash flows will drop. Eventually, to the day before repayment of par value, it's going to be worth $1,000. Okay, so if interest rates never change again, a premium bond's price will continually drop over time. And this can get kind of important if you're a bond investor, because sometimes there may be differential tax rates on the change in the value of the bond versus the income you get from the coupons, right? So premium bonds, the reason they're premium is because they have a super high coupon rate. So most of your taxes are going to be based on the coupon payments. The capital appreciation is going to be negative. A discount bond, the dashed line, conversely, the reason it's a discount, it's trading below 1,000, is because it has a really low coupon rate. And so you're not going to get much income from the lower coupon rate. You won't have to pay as much taxes, but the value of the bond's going to go up every year, so you're going to have some capital appreciation. And the way bonds are, sometimes you do have to pay taxes on capital appreciation. It's kind of weird, even though you don't sell them. I'm not an expert on the code on that, but just something to take into account. All right, default risk and bond rating. So I think you guys may have gone over this a little in Finance 300. So, right, we basically have three classes of bonds in terms of risk. There's investment grade, speculative, and bonds that are already in default. The investment grade, if we just look at the S&P system, because each of these companies, S&P, Moody's, they have like a rating, kind of like you and I. We have a credit rating or credit score with the companies. Bonds and the companies that issue those bonds also have credit scores, but we call them credit ratings, and they're done by companies like S&P and Moody's. And for the safer bonds are called investment grade, and S&P classifies them as AAA through BBB. The riskier bonds, these are sometimes called junk bonds or high yield bonds. S&P labels them BB through CC, and then bonds that are already in default are C and D. This slide here kind of shows AAA is the safest, then there's AA, then single A, BBB, and then right here between BBB and BB is kind of the demarcation between investment grade up here and junk down here, riskier. And it's kind of important because there's some investors, like insurance companies, who have to buy safe debt. They can't be buying really, really risky debt. And so for like an insurance company, they're going to only focus on investment grade bonds. Okay? And this chart just shows you some of the average financial ratios of companies in these credit risk categories. And notice down below on B, it shows a historical default rate. And even AAA, the safest of the safe, there's 0.5% of in history, the population, those companies have defaulted. So it's not perfect. Conversely, BB here, the beginning of the junk bonds, it's about almost 20%. Pretty high, right? So how can we have protection against default? Couple things we could have in the bond indenture. One, sinking funds. That's where basically a company puts away money to pay off some of the principal as they go. It's kind of like a consumer loans, how you pay some of the principal as you go. You're not just paying interest, but you're also putting some money down to pay off the debt, right, as you go. That's what a sinking fund is. Subordination of future debt. That basically means if a company sells bonds, then at some point in the future they decide to sell more bonds, the original bonds can say any bonds you sell after my bond are going to have to wait in line behind me when you go into default or when we go into bankruptcy. I have to get paid before they get paid. Sometimes we call that senior debt. So like there's a seniority status of who gets paid first in the event of bankruptcy. So that can be laid out when those bonds are set up. Bonds can restrict in the bond indenture how much dividends a company can pay out. Because just imagine if a company knew that, like, boy, it looks like we're going to go out of business in 6 months. And if we just sit here and do nothing, we go into bankruptcy and the bondholders are going to get all our money. Why don't we pay out some special dividends to ourselves? The company may go bankrupt in a matter of 2 months, but at least we get more money out of it. So bondholders know that there's an incentive to do that, and so they will restrict a company's ability to make dividend payments because of that. And sometimes there could be specific collateral, right? There could be equipment or something like that. Think airplanes, big pieces of equipment that creditors can get their hands on in case of default. And I'm going to stop there. I was having some trouble with my software. It seemed like the shorter videos don't cause my computer to crash. So I'm going to pick this up on part D.